Hi, everyone. Just before we get going, I want to remind you that everything we talk about and discuss should not be considered as investment advice. The purpose of what we talk about on Catherine Murray Media and Markets on YouTube, as well as Catherine Murray in Conversation With on my podcast, should be viewed as informational and entertainment purposes only. Please definitely do your own research, your own homework, and definitely consult an investment professional before making any investment decisions. And also to note, some of us might hold positions in some of the stocks that we discuss. Jack, great to be able to be with you and get caught up in terms of your views, because I think that there's a real debate going on in the market in terms of the bulls versus the bears. There's plenty of reasons, I think, to be bullish, just because I think we've got so much liquidity, but there's also, of course, concerns regarding peak growth and the variance and how all of this will play out in terms of policy makers and what that means for the economy. So I think from a macro top-down perspective, let's hear how you're looking at the world today.
Sure. From big picture, let's start with valuation first and foremost. And valuation is unfortunately very expensive. If you look at the CAPE ratio, you look at price to sales, virtually every metric, and I'm not just talking about US, I'm talking about most global markets. Maybe you can find a few unturned stones in the emerging world, but generally equity markets are pretty fully valued, in some cases pretty expensive. Now, that said, of course, valuation is a terrible timing tool, and I wouldn't use valuation unless you had a time horizon of 7 years or longer. So we can check a box and say, okay, valuation expensive. The economic backdrop, meanwhile, is great, at least near term. We're off to the races here in the US. Obviously, we're now watching the Delta variant. We're seeing, many of our trading partners internationally lagging behind in vaccinations, most notably Japan, South Korea, Mexico, all still have vaccination rates below 20% of their populations. And so we'd like to see that pick up so we can get this reopening going. And even here at home, certain states, we're seeing lagging vaccination rates, and we're now seeing infections pick up. The third point, and that's liquidity, enormous. We've never seen liquidity like this. We're seeing real rates at more than 1% negative. Banks and lenders are tripping over themselves to put capital to work. Everyone's looking for yield, and so yields and spreads have gotten compressed. And so anyone looking to raise capital should find an easy time doing it, whether you're a business or consumer. And that's really what I'll call liquidity, the circulatory system of financials. And you're right, that's great. Investor psychology, probably, a little on the bullish side. Maybe we got a little ahead of ourselves, over our skis somewhat in bullishness. That's pared back a little bit. I don't think we're at extremes, so I think the market can keep going higher. I wouldn't call it a wall of worry necessarily, but certainly, I would say most investors, if you look at polling data and some other things, are sanguine, but not necessarily ebullient. And then, of course, lastly, technicals and momentum still pretty powerful. So putting it all together, it's, the path of least resistance is higher, but longer term investors may want to start paring back some of their risk.
Okay, so a lot there certainly to unpack. Why don't we first start with the variants and the vaccinations? It's interesting to me that it's almost as though the vaccinations, it appears in the United States, has stalled out, and perhaps that's because a certain percentage of the population will never get vaccinated. And I wonder what that might do, or what kind of impact that will have in terms of policy decisions, because if that's the case, and that's always going to be a significant risk out there in terms of the reopening trade, I do wonder a little bit if the reopening trade can continue to work, but maybe at a slower pace, and some of the stay-at-home names will continue to work. It's almost like the slow moving along of both aspects can work in the market. Do you see it that way, or what kind of impact do you see this having?
Yeah, so, from a market impact, you're right. You're seeing this tug of war between kind of the stay-at-home growth quality names, the Netflix and Googles and things like that, against a lot of the reopening names, the airlines, the hotels, the cyclicals, the industrials. I think that generally the investor thinking was, okay, there's this variant out there. It's impacting the unvaccinated. These people have a choice to either vaccinate or not. We're now learning that perhaps employers can require vaccinations of their staff to come into the office. So I think from that side, the thought was we could perhaps have two economies, so kind of a vaccinated economy and then an unvaccinated economy, where vaccinated likely concentrated, in the cities anyway, and the unvaccinated would be more in the rural isolated areas. But now we're encountering these breakthrough viruses where vaccinated people can get COVID, maybe not as severe, but it's certainly a risk. And that's really started to set the market back a little bit, that perhaps we can't run on this kind of two-stage recovery plan.
So what then does growth really look like in your view for the next 12, 16 months?
Yeah, so I think growth, does probably peak this year. It has to, right? I mean, we're looking at 9% real GDP growth this quarter, maybe 13% nominal GDP growth for Q2, and even probably 10 nominal growth for next quarter. So clearly, we're peaking, cresting at this level. But I think that real GDP growth next year probably still above 2.5%, closer to 3%, which is still not a bad longer-term trend. I was a little concerned that Goldman Sachs reduced their equity forecast for 2022. I think they're calling for 1.5% to 2.5% growth for next year. So that's a pretty big downgrade. But for right now, I would say, I still think we can get to that 3% growth rate, which is a healthy number. Really, the wild card is going to be inflation. And I still believe inflation will be more persistent than we believe. Right now, the inflation that we're seeing is not inflation that the Fed has caused or can be controlled by the Fed. And that's because it's supply disruptions, right? If you look at used cars, you look at hotel rooms, you look at airline seats, things where there's really just a lack of supply. And that's not something that lower rates can manifest, or even maybe higher rates can probably quash. But I think the Fed realizes that there isn't a heck of a lot of control they have over the inflation that's out there now. I think what happens though is we have to keep in mind, at least US CPI is dominated by housing. Nearly 50% of CPI is housing. And when we're seeing housing prices now, median home price, I just saw around 500,000. I mean, that's up from about 350,000 not long ago. So housing prices are really high. My guess is that translates to rent. And the calculation of owner's equivalent rent really, I mean, it's half of CPI. And then you add another 15% for transportation. And I think we're going to see some persistently high inflation numbers. So, I worry that we get into an environment where we've got, call it 2.5% to 3% real growth, and we've got 2.5% to 3% inflation. Then what do you do?
Right. And I saw your presentation and you bring that up. And it does have interesting implications and some complications, I suppose, for, getting return on your investments and your money.
Yeah, that's it. So, one of the things that we have to be thankful for the last 10 years is valuation expansion. I don't think investors realized how much performance we got from valuation expansion. So let's break it down. As an investor, you're really only entitled to two things, right? You're entitled to earnings and you're entitled to dividend yield. I mean, that's really all that companies that you own produce for investors. There is one element. If you can sell at a price higher, at a valuation price higher than where you paid, you're going to get some extra return. And that's really most of the return that we enjoyed over the last 10 years was from valuation expansion. So if you go look between, say, 2010 and 2020, the S&P 500 cumulatively returned about 270 percentage points. And 170 percentage points of that was valuation expansion. So another 100% was from earnings and dividends. And valuation expansion is purely and simply a function of interest rates. As interest rates drop, that means the earnings yield can decline. That means the reciprocal of the earnings yield, which is P over E, which is the PE ratio, can expand. And so if we get into an environment now where interest rates don't decline or maybe even rise a little bit because of this inflation, what I'm arguing is, okay, let's forget about valuation compression. Let's just take valuation expansion off the table and say, what happens to the market then? Well, okay, we're going to get, a lower trajectory. It's going to be a lower returning market if we don't get valuation expansion. However, it also changes the dynamic of what sectors you want to own, because tech, because you have to pay so much for earnings and tech doesn't have much dividends, the return that would migrate to investors without valuation expansion is pretty low. Whereas industries like financials, industrials, kind of the sort of the back to basics type industries do well because earnings yields are higher, right? The PEs are lower. Dividend yield is higher. So I think we're going to enter an environment where it's kind of a back to basics, bricks and mortar type investing scenario, unless of course we get breakthroughs in technology, which can certainly happen, and we get some kind of huge productivity gain. But aside from that, I think investing in kind of the Main Street, the industrials and the banks and sort of the basic stuff, the brick and mortar stuff, I guess I'll call it, versus the virtual stuff, we may be better off over the next few years.
Right, which I can certainly appreciate. And I think that, some people have been thinking that might be the right call for some time now, Jack. And yet, so often, again, we see the market leadership really surrounding some of those big tech companies. And obviously some of the semiconductor companies, they're cyclical, so I'll put them aside. But I do wonder, though, if we aren't in a little bit of a new paradigm just because we've become so dependent on technology that the Apples of the world, Googles, Facebook, maybe Twitter, Netflix, that those will still be the dominant players. But then at the same time, I lived through the tech boom bust, doing equity research at William Blair, building these, models in 1997, 98. And then of course it all, it came about on a negative side after the boom bust, and those big tech companies fell for 10 years. But I do wonder if maybe it's different this time, and I know that's the worst thing to ever say on Wall Street. So I don't know. How do you see an Apple playing out as an example?
Sure. No, I don't see necessarily these mega cap tech companies, of course, all reporting this week, are going away anytime soon. I think they are dominant. They've certainly inserted themselves in our daily lives, and I don't think that's going away. In fact, my view is when they get that big and that dominant, the only threat they face is really government, right? It's government regulation. Of course, we're seeing now Beijing cracking down on some of their mega cap tech companies, and the fallout from that. And I would argue that Democrats and Republicans here don't agree on much, but I do think they do agree that a lot of these mega cap tech companies have probably a little too much power, either political or market power, and probably does need to be checked. But aside from that, you're right. I think fundamentally they're not going away. My guess is that they may lag just because their valuations have gotten so expensive. And it's are they growth companies? Yes. Are they safe havens? Well, in an environment where there's little growth, they are safe havens. They have high quality, strong balance sheets, big cash balances. So they're not certainly the fundamentally going away, but that valuation could erode.
No, fair point on that. And also, of course, where are the best opportunities? And you do highlight I think more the value oriented plays like the industrials. What else kind of fits into that call, that theme?
Sure. So we launched a strategy. We have a series of we create these specialized separate accounts, these portfolios for our clients, where we think there's some opportunity and legs. And fourth quarter of last year, in anticipation of reopening, we assembled a portfolio called Quality Dividend, where we recognize the value of dividend is going to be important. But we also want the persistency. So we want companies, high quality companies that pay a good dividend, have strong balance sheets, and have a fair amount of pricing power. So when you look at a J&J, or you look at some of the healthcare names, a few of the banks, in some of the industrial companies, a Honeywell, that kind of thing. That's where we're putting money now. And we think, we'll call it a no news is good news portfolio, because it's got a yield of, call it 2.5 to 3, and very solid dividends.
And speaking of yield, obviously, a lot of the time I started off the conversation in terms of what the yield environment looks like, the U.S. 10-year yield. And of course, that impacts the valuation as we did discuss. But what is your view in terms of where we see the U.S. 10-year yield over the next, again, 12 to 16 months, maybe 2 years out? Is it going to be range bound, and will there be some volatility surrounding it? But, that's almost just part of the story of today.
Yeah, I mean, I think the academic in me would say the 10-year Treasury yield has to be higher. We have a model that looks at copper divided by gold, and I haven't run it in the last week or two, but I will say a couple of weeks ago that number suggested that the 10-year should be 2.8, not 1.2 or 3. So I think that clearly the fair value for yields is higher. But I think the practitioner in me says that, okay, yeah, it may be that the 10-year should be at 2.8 or closer to 3, but how much of this economy and market can really withstand that before rolling over? So I think we've kind of entered a new phase where we've had low interest rates, aggressively low interest rates for so long. We've now built business structures, investment theses, strategies predicated on this low yield, and that raising that yield could undermine so many structures that it would kind of cascade on itself. So I think that where normally you would say, look, if you've got a 2.5% real GDP growth and another 2.5% sustainable inflation, that would suggest a 5% 10-year Treasury, but our market structure won't support that. So I think you're right. I think we will trend higher. We'll probably hit up against a higher level limit and kind of roll back down. So I do think it could be volatile, but I do think the trend in yields is higher.
Do you think, though, to your point about yields being too high, that the business environment globally and the markets globally are not prepared for that? I mean, I think we kind of all know that, and that is the biggest fear, or a big fear out there. Do you think that the policymakers are acutely aware of this? Of course, there's the FOMC meeting today and tomorrow, but do you think that policymakers and governments around the world are just so aware of how dependent they are on lower rates because of the amount of debt that's been created, that that's going to put us in a low rate environment for the next 10 years?
Yeah, I mean, I think we've kind of made that bed. And I would say most policymakers are aware of it. I mean, if you look at the Russell 2000 small cap stocks, last time I checked was a few months ago, more than 25% of the companies in the Russell 2000 have not made a profit in 5 years. If you can't make a profit in 2018 or 19, or even this year, I'm not sure what the going concern value of the business really is. And so I think that there's certainly a solvency issue that if rates don't stay low or continue to go lower, that's going to call a lot of business models into question. So I do think that, even if rates stay where they are and go up slightly, we're going to get some attrition. mostly in the smaller cap names, both here and internationally. Yeah, I think we've entered a low rate environment that it's going to be very, very difficult to get out of.
And just to go back to a previous comment in terms of the copper gold ratio, give us a bit of a backdrop as to why you look at that, and do many people still look at it, and what's the significance?
Sure. So, consider these two commodities. They trade, pretty liquid markets, where copper is a pro-cyclical commodity, gold a defensive commodity. What we have found was that ratio has been a very good coincident and slightly leading indicator of the 10-year Treasury yield. So, we've liked it just because it's really been a valuable tool for us. It's only in the last couple of months that it's really diverged away from where the 10-year Treasury yield is. I mean, it leads it on the downside and the upside. So it's possible we could see, copper, come down and gold go up, and have it come down to meet the 10-year Treasury yield at 1.2 or 3. But my sense is that gap needs to be closed, and it will likely be higher yields, some combination, maybe lower copper and higher yields.
Okay. And what do you think of some of the materials these days?
Yeah, so we're big. We're still investors, big investors in energy. We started the year just saying, energy's cheap, and the reopening trade's going to help energy. That's working out. MLPs, in particular, energy infrastructure, up about 50% year to date. We're probably closer to declaring victory in that one than maybe adding much more to it. We have to. We'll reconvene on that. We also took some equity risk off the table a few months ago, just because valuations, and our view is a 7-year view. We added gold. The logic in gold is very simple. If financial assets can offer investors a yield ahead of inflation, right, in excess of your purchasing power risk, go ahead, buy financial assets. But if financial assets are locking you into a lower standard of living, a lower yield than what inflation can offer, then you ought to own gold, because gold has had a long history of at least tracking inflation. In fact, over the last couple of decades, it's been slightly ahead of inflation, but over the long period of time, gold is simply just purchasing power protection. So if you're not going to make a lot of money in gold relative to inflation, but at least you'll stay on that escalator. And if financial assets can't get, that trajectory of their escalator is slower because, in this case, the 10-year Treasury more than 1% below the inflation rate or the expected inflation rate. You've got overnight rates at, right now, 4 or 5% below the most recent inflation print. Might as well own gold as an alternative to cash. And the fact is, yeah, gold doesn't offer any yield, but neither does cash. So the opportunity cost of owning gold is nil.
Got it. With respect to gold, how do you like to buy it for your clients?
It really depends on the purpose. So if you want some liquidity, I always want some kind of product that's backed by physical gold. So in the exchange traded fund space, there's IAU. I think it's an iShare product. It is backed by physical gold. For longer term holders that really want to take a strategic position in gold, BMO has a Canadian gold product that they can hold in Canada, in a vault in Canada, or they will send it to you and you can take delivery of it. But that's obviously physical gold as well.
Mm-hmm. And Jack, you mentioned this in terms of your view, a 7-year view, and you also made the comment at the top saying that, look, if you've got a 7-year time horizon or longer, maybe we don't need to worry as much about taking profit off the table. Can you just explain that a little bit more? Because I think that a lot of people who follow me, depending on where we are in our age and stage of life, but wanting to make sure we've got capital. What's the thinking in terms of that comment?
Sure. So everything that we do at Crescent goes back to goals-based investing. What goals-based investing does is it says, all right, what's the cash flow that my client needs from their portfolio over a period of time? And let's say they're just entering retirement. So maybe they have a 30 to 40-year time horizon. So what we say is let's match the investments with the cash flow that's needed. So of course, if you need money, next year, the year after, and maybe out to say 7 years, we're going to have to build a short-term bond income-oriented portfolio to match those cash flows. But any cash flow that's 7 to say 15 years, we don't need to rely on bonds. We should be able to rely on equities to meet those cash flow needs with a 7 to 15-year time horizon. And then anything beyond 15 years, we can really look at much higher return, higher octane strategies. We do thematic strategies. We look at private equity, private real estate. So we have a whole kind of array of investment tools at our disposal, and that we just try to match the cash flow. So that's why our equity investing, I wouldn't, think about it this way. If I had a cash payment due next year, let's say I had to pay taxes and I needed to set money aside, I don't care how bullish I am on Apple stock, I wouldn't put that money in Apple stock. I wouldn't put it in the S&P 500. I don't know what that the portfolio will do between now and the time I need to pay that out. And so I need to in order to raise my probability of success of meeting those cash flows, it really comes down to just matching your investments with the cash that needs to be paid out.
But the idea though of owning dividend stocks, does that fall into your cash flow?
Yes. So okay. We will take yield from private equity, cash flowing private equity, even though it's holding a 15-year time horizon. We will use cash flow from private equity and real estate to help fund lifestyles up front. Absolutely.
Okay. And it was interesting in your presentation as well. You had different solutions for different risks out there. One of them is the potential of higher taxes. So what are some of the solutions if that's the environment that we're going to be facing? Sure.
So, with Biden and the company talking about paying for the infrastructure package, which is still out there, one of the conclusions was let's double the capital gains tax. So let's take it from 20 to 40, essentially. If that is the case, what we find is even if the capital gains tax instead goes from 20 to 28, it still makes sense if you're willing to, if you were planning to take money out anytime between now and the next 10 years, to go ahead and realize that capital gain in 2021 and then just redeploy it and just essentially raise your cost basis. So those are some of the break evens with that. We also have the possibility of converting from, in respect to maybe higher current income tax rates, moving from traditional IRAs to Roth IRAs, pay the tax this year, and then get lifetime tax exemption on those proceeds. We've launched our second now qualified opportunity zone fund, which will take capital gains realized this year and essentially defer them most of that capital gain indefinitely. So there are a lot of different tax strategies that are available to investors in the U.S. And we're pretty much on top of most of them.
And you also make the point, I believe, about having separate accounts, that your firm offers separate accounts. Is that how you go about investing for your clients?
That's our preference. So what we do is we say, look, from a tax perspective, we're really not big fans of mutual funds. It's because longer term holders are forced to pay capital gains whether they continue to hold or not. So it's in many respects it's like riding the bus, right? Your journey really depends on what other people do and the stops along the way. Even though you may be riding for an hour or two, you may have to take stops along the way, and you're paying other people's tax liabilities by holding a mutual fund. An exchange traded fund at least gives you the advantage of controlling your own destiny in terms of capital gain. You're only going to pay the capital gain, when you actually exit the fund and transact. But separate accounts actually gives you one more layer, and we create separate accounts for our clients, essentially customized indexes or other strategies, where now you can actively take losses. You can go through the portfolio and offset gains and losses, or continually generate losses. So now you can actually be out front in your tax strategy, and maybe use losses that you use by rotating individual holdings in the separate account, and use those to offset gains that you're taking somewhere else in the portfolio.
And that's a big distinction, I think, that individual investors need to know and understand. So I appreciate that comment. Do you only have accredited investors and U.S. investors?
No, we have accounts. We have accounts of all sizes. We actually can take Canadian clients too, provided that they're comfortable with all of the U.S. elements associated with it. But yeah, we are very tax aware, and I would say pretty cost effective. And really, I would say our two value propositions are the goals-based investing, where we can pretty much customize a portfolio to lock in your cash flows, and then take whatever's left over to do really interesting other things. And the other is access to private investing. We have a whole team looking for individual companies, individual buildings, different funds that we put together, and then we will also curate different strategies for our clients. So it's a really, really interesting, investment opportunity set that we put together.
Yeah, and you've had such an interesting career, so I'm sure it's the culmination of all of that. Is that correct?
Yeah, it is. I mean, I think that, I had spent 17 years at BMO, and I love the company. I'm still in touch with everyone there. But I felt that about 4 or 5 years ago, I realized that private investing was going the way of goals-based investing. Again, creating what I call these customized defined benefit programs for our clients. And the ability to do it with a clean slate at a new company that we started in late 2017 and 2018 is much easier than taking a 200-year-old firm and saying, let's put a stake in the ground and decide we're going to do investing this other way. Nothing against BMO, nothing against how the large banks invest, but I wanted to be able to really try it. That's all. Try what I think is proving to be, a really clever way of investing for clients who are especially looking for specific cash flows on specific dates.
Understood. Jack, it's been great catching up with you. I appreciate your time, your thoughts as always. And it's nice to be able to do this in a little bit of a longer format and hear more about Cresset Capital. So thank you.
Great. Thank you, Catherine, and good luck with the program. Look forward to watching it.